Welcome to the Australian Property Investment Podcast with your host, Aaron-Christie David. Each episode, we ask an expert to share their key insights for aspiring investors to make confident property choices.
G'day everyone, welcome back to another episode of the Australian Property Investment Podcast. We're all about helping investors make better property decisions. And as part of that, we like to look under the hood of another number of topics and frequently asked questions that we get from our clients and potential new clients that come to us as well. And as part of our commitment to education and to sharing knowledge, we like to invite an expert to come along and share their insights with us. And today, we're so thrilled to be joining this year with the CEO of Illawarra Credit Union, Anthony Perkiss. Mate, welcome.
Yeah, thanks, Aaron. I'm not quite sure if I've been referred to as an expert too often. Appreciate it all the same. Thank you.
No one gets the area of expertise and position that you have without being an expert, perhaps. So, mate, we'll go on a journey. But, mate, you and I had a chat a little while ago, and I guess what kind of pricked my ears was Illawarra Credit Union is probably someone that flies very politely under the radar. You guys probably punch well above your weight as a lending institution. And I guess when I deal with a lot of clients, something that comes up is the size of a lender, for example, equals more security. And it's probably one of the topics that I wanted to have a chat to you about. But before we did, I just wanted to, just for everyone listening in, a little bit about yourself personally and professionally, if you may indulge.
Well, I'm the CEO of Illawarra Credit Union, been in the role for the past couple of years, but joined the organisation back in 2012 as the CFO. My background's been in banking since I left high school, so I've been in banking now, or superannuation and investment banking for close to 28 years. Yeah. So that's showing my age a bit.
Mate, you don't look a day over 20-something, mate.
Yeah, so thank you again.
For a CEO role, perhaps.
Yeah. So, look, I guess I've lived and breathed banking in financial services and investments and, been enjoying it for my whole career thus far.
Excellent. I mean, over that time, a lot has changed, but then I'll say a lot hasn't changed. Like going for a loan, I think even my parents went for it, was still a daunting experience. Even today, it feels like it's a daunting experience.
Yeah, look, as an organisation, financial services organisation, one of the things that I think hasn't really changed is the financial literacy, and that's something that we see across the board, and people see buying your home is a really complex process. Yeah. And also it's one of the largest financial transactions anyone ever does. So, that is daunting of itself. And in this day and age, in this current market, we're seeing, people borrowing some serious sums of money. Yeah. So from that perspective, I can only imagine when I was borrowing a few $100,000 for my first home loan versus maybe potentially having to borrow close to $1 million. It just sounds bigger and sounds pretty daunting to me.
Yeah, absolutely. Look, in your role as CEO of a credit union, there is a perception. I won't say it's at you guys solely. There's a number of credit union building societies out there, so smaller lenders. They may be called risky because you're smaller. For example, for anyone listening in, can you dispel that myth? For example, that small equals risky or bigger equals less risk compared to, say, a major bank?
Yeah, look, I guess that normally comes back to how well known your brand is and the fact that, unlike the major banks, we don't have the marketing budgets as they have to really get our name out there. Traditionally, we've always serviced a niche market, but as the Illawarra Credit Union, we've actually been around since 1972, and we've been supporting a lot of local borrowers in the region. But also, 50% of our customer base comes from outside of the Illawarra region. So I think people have had these misconceptions that not just credit unions maybe equal smaller, but they might be attached to a certain industry or region, and they don't normally bank a broader community group, which is wrong. We service people from a wide range of industries and regions. We've got customers from all around Australia. What also I think people maybe don't understand is that we're regulated just like all the other big banks by APRA. Yeah. And APRA's mandate is primarily to protect depositors. And that's where the government then gives us the government guarantee of $250,000. So we have the same government guarantee for depositors as a major bank does for their customers as well. I think what is really a bit different between us and obviously the bigger guys is that, most of our source of funding come from mum and dad and normal customers depositing money with us, and then we go and lend that. The bigger banks, they might, they'll have retail customers, but they'll also borrow a lot of money from, offshore or other types of corporate. So it's the way we source our funding, the way then we would lend to customers. People may think that we're a little bit more conservative in our risk appetite and the way that we might lend to people, but I don't think that's necessarily the case. We see a lot of competition in the marketplace, and we compete pretty well with major banks, and even the second-tier banks we compete very well with. But look, people have probably always put this mindset of small means riskier. But certainly from our perspective, all the hurdles we've got to meet when it comes to our regulators, I don't think we're any riskier. And in fact, it's normally the reverse. People who deposit money are more concerned about the safety of their deposits rather than where you might take a loan out. So I think why people might think it's risky to borrow money from us, I'm not quite sure, but
well, I joke about it to every client that asks, like, I haven't heard of them. They sound risky. I'm like, actually, they're lending their money to you. The risk is really on them as a lender, as opposed to the other way around, right? They're taking the risk on you as a borrower is really the big risk to a bank, isn't it?
Absolutely, and that's where when we make decisions, we're lending our customers' money to a borrower, and that's where we need to assess the risk. And that's where we then determine, are they good credit quality? And if they are, then we'll lend them the money. But it's the risk is the other way around.
You spoke about lending criteria, for example, and I guess when we're on this side of the fence, which is when we're broking or in the banking side, we call it credit policy or lender policy or risk appetite, for example. So these banks have a certain sweet spot or a certain niche, for example. But from your perspective, what is credit policy? And I guess how does Illawarra Credit Union differentiate itself from other lenders as well?
Yeah, look, I think when I look at lending policy or credit policy, it's a guide. The guide it instructs our lenders to tell them what type of customers or what type of risk we want to take on and what we would lend against, what type of assets out there. And there's many different types of borrowers. There's first-home borrowers, there's investors, developers, people just wanting to knock down, rebuild. There might be someone wanting bridging finance. So all of these things, different companies will work out whether or not they want to play in that space. For us, fortunately, for our size organisation, we play in all of those spaces, and we do a small component of commercial as well. But basically, it's a guide. It falls under our risk appetite. So, the board of the organisation helps set the risk appetite, and that also falls under the APRA regulations as well. So, we base our risk appetite based on what APRA and the board are willing to do for our business. We then talk to customers and obviously work out whether or not they can afford either the $1 million property or the $800,000 property. But what determines that is, obviously how much people earn and what their commitments are and a whole range of other things. But predominantly your lender's policy will look at the type of asset, the type of exposure we want to have. And then you get into other things that we all talk about, like loan-to-value ratios and where the property is even situated. If it's a rural property, do we actually want to take that risk? And some people do and some people don't.
Yeah, perfect. And I guess sitting behind that is when you're looking at other criteria, living expenses, they can change from bank to bank. What we call an assessment rate will change bank to bank. So some banks are a little bit more generous on, say, an assessment rate, which is what serviceability rate or this the floor rate is. And while the client gets 2.5%, they might be assessed at 5.5%. Some banks are higher and some banks are lower, which gives you different varying degrees of borrowing capacity as well. Rental income, it's what we call a shading rental income. Some banks will take 100% of rental income. Some banks will take 80, for example, as well. So in your, I guess, is it the board that makes those decisions then, Anthony? Is it kind of in consultation with someone like yourself or people that are on the ground client facing? How do those decisions get made about where do we kind of dial up on how much rental income we'll take in versus living expenses as well?
Yeah, look, we get given guidance by both the regulators, ASIC and APRA, around what kind of additional buffers we add to interest rates, what the hurdle rate we might, or the effective rate we might assess a loan at.
Yeah.
We then, whether we've got to take, if it's prudent to have a haircut on bonuses. ASIC gives a guidance under rental income, especially for someone who might be, it might be a new investment property. There's no history of rental income. We'll take a haircut on the estimated rental. But if there's history, you're refinancing your investment loan, you've had 2 years of rental income, and we can justify what that rental income is, we may not take a haircut on that rental income, and we might assess 100%. So it really comes down to the situation that the borrower is in, and whether it's like existing and we can justify a regular payment year after year or month after month, or if it's new and it's a one-off payment and things like that. Yeah,
okay. Yeah, perfect. No, thanks very much for the explain. I really appreciate that.
No, that's fine. It's a hard one to try and work out, because we, even as a lender, we sometimes scratch our heads and wonder, if we've said no to someone, but then, they go to another financial institution and get it approved.
Oh, great.
We ask the same question. We say, well, how did that happen? So I can only imagine if it's confusing for us, it must be confusing for, your clients as well.
Oh, I mean, yes, you're spot on. That example will happen, the broker versus banker conflict, for example, where they'll go to a broker and say, look, you can't borrow that. They'll walk into a branch and get it, or even vice versa. So sometimes it is open to credit policy interpretation. Sometimes it's open to, I guess, flexing it and say, are there grey areas as well? But quite often policy is policy, right?
Yeah, I think there's a bit difference there. For us, we notice that we might take different sources of income, government payments, which other lenders may not. We will look at every deal maybe a little bit closer, rather than, some people might rely more on automated credit decisioning.
Yes.
And through that process, you either fit in the box or outside the box. And whereas we don't really rely so much on the auto credit decisioning, so we will treat individuals on a case-by-case basis and try and work out if there's a deal there. We also see sometimes, though, that deals fall over if potentially there might be a high-rise apartment block that's been blacklisted by a bank, or maybe someone might have an overexposure in that unit block.
Yeah.
And, they might say no to a deal that another lender will do, because they don't have any exposure to that kind of unit block.
Yes, but that's something that a client may not be privy to, but I guess we're close to it because we can see where the banks have security development registers, or they've got postcodes which they have very clear guidance on what they will lend and what they won't lend on as well, isn't it?
Absolutely, yeah.
Perfect. I mean, speaking of lending and when a bank will say no, one of the common ones we get is when investors start to build their portfolio, and as it gets bigger and bigger, some banks impose what they call a loan limit or an exposure limit as well on how much they will lend to a particular client. Trying to explain that to an investor, for example, that says, hey, I want to buy the next property, and the bank saying you're actually overweight and we're going to lend you too much. They left their heads scratching a little bit going, hang on, I actually want to borrow money from this bank and they're going to say no to me. I'm going to go somewhere else. And I guess it can come out a little bit misinterpreted to say, we want your business, but actually it's becoming a risk. So how does that, I guess, going back to a client, how do we say that politely to go, you're borrowing too much, or now it's become a risk to a bank?
Yeah, look, we know that out there, different banks might do up to 5 investment properties, and then, to kind of reduce their risk to one particular borrower, they're happy for that other loan to go somewhere else. And we find ourselves in a similar situation. You could be exposed to a number of properties or to a total value. So again, I'm not privy to what every other organisation's exposure limits are, but obviously APRA do influence our exposure limits per customer, and we then work within those confinements. That means that we may not necessarily have the same appetite to lend as much to one customer, but I think prior conversations, we will have clients with $6 million worth of lending, and that's not outside of our realm. We've also had clients that want to develop up to 6 units or 6 townhouses, and we get involved in that type of lending as well. So, it's a tricky one, and I can only understand it'd be frustrating for investors who feel like, well, hang on, it's a deal. Someone else is prepared to do it, but it's really the banks trying to just minimise some of that risk. The other thing that we see even is debt to income ratios at the moment.
That's a relatively new one, right? Because debt to income ratio is almost something reserved for, say, commercial lending. Yeah. Previously, now it's become a very residential focused metric, and a client doesn't get it. But why the debt to income ratio? Why does that become so prevalent or important for you guys, mate?
Yeah, look, it basically came out a couple of years back when the regulators said that they were having a look at the market and wanted to try and reduce the heat in the marketplace. This is when investors were really getting into the market. So
those interest rate caps coming out as well, wasn't it?
Yeah, and so they were interest-only lending, and a lot of investors were rushing into the market, and they wanted to kind of cool the market. So they looked at the debt-to-income ratios and said that, when people start to get 6 or 7 times, you're starting to look at potentially mortgage stress or future stress. And what that might have done is also inflate asset prices. So there was a lot of concern around that. Go back 2019, 2018. Doesn't feel that long ago, but it is a couple of years now. But and look, don't get me wrong, they still look at that. And there's a lot of banks out there with different approaches to debt to income ratios. We still talk to our regulators around that, and they are still monitoring it. Sometimes a bank might say if you're a debt to income of 7, even if you've got surplus income, they may not do the deal. We see some people who've got debt to income ratios of 10, but huge amounts of surplus. But we still will consider that. It's outside of our policy, but we will still consider that on a case-by-case basis and either refer it to the board for approval and also talk to APRA about it.
Yeah, okay. That's the part where you go, hey, you're not black and white, where some banks, it's just straight policy to throw the book at you and go, we're not going to do the deal. Whereas sometimes with, call it a small lender, with all due respect, small lenders are sometimes open for business because you can be a little bit more nimble to make those decisions as well and consider it on a case-by-case basis, as you mentioned.
Yeah, look, it's also, when we have won customers, it's difficult to let them go. And so we want to do business. As you say, we're open for business, and we want to make sure that the regulatory system is fair and equitable as best we can, and we have those kind of conversations with the regulators and talk to our customer-owned banking code of practice and our banking association about making sure that everything's fair and equitable. But yeah, look, it's disappointing if I've got to say no to someone, even though it's a good risk. It might have a low loan-to-value ratio. It might have a high debt-to-income ratio, but good serviceability and good surplus monthly repayment amounts. So they're not going to be in stress, but, you don't want to say no to that.
Yeah. You mentioned there about the market as well. You go back to, say, you go back even a few years, the interest-only kind of caps that came out after the interest-only boom at, say, 14, 15, and all those changes that came out in 2018, 2019 to stem the market. Then you look forward to that 2020, 2021. It's like absolutely shooting the lights out at the moment. So, regulation will only get us so far to stop the market, but it is an open market. So I guess when you pull the crystal ball out for yourself and your team, and I guess your internal economics team, your pricing team, your risk team, your sales team, and you're going, okay, what does the outlook look like for us as a business, but also as a macro market? Where do you see the market playing out from your perspective, Anthony?
Yeah.
I'm not going to hold you to it either. Just as a huge idiot, this information is general in nature, so we'll put the disclaimer in there. But I guess, from as you guys have a market outlook, what does that look like for yourself, and even just as a normal home buyer or investor yourself personally, mate?
Yeah, look, I guess we've seen a lot of people who have got pre-approvals for home loans, obviously in the owner-occupied space, and also some investors. There's just really low stock at the moment. So, again, there's so much competition in the market. People are buying properties from offshore, sight unseen.
Sight unseen, yeah, correct. Even just, locally, they'll buy sight unseen because they can't come down from, say, Sydney.
Well. And so we've got people who are constantly trying to get a foot in the door. It's just difficult. So, there is a shortage of stock. Obviously, there's people either looking at land or buying further out. And we're not necessarily seeing that house prices will soften or anything like that. From what I'm reading, people are still expecting house prices to rise over the next 12 months. I guess there's still concern there around what will happen when interest rates do start to rise, and just when do they think that might actually happen, given this latest lockdown of COVID. We're not really sure what impact that has on the broader economy. We have seen some people calling up around deferred home loans and deferred repayments, and we help our customers out where we can in that situation. So there's kind of a couple of moving parts in the economy. There's going to be some obviously softening of jobs in some areas, which we're seeing. We're hopeful that we're not going to see any spike in unemployment. People are still well advanced on their repayments. So I'm not seeing this major issue occurring. Obviously, investors, I think, are starting to get back into the market.
Absolutely. Absolutely.
But again, what are they buying and where are they going to buy? And obviously that's for an investor to consider, buying the quality kind of stock out there. But even if you are an investor and you're ready to buy, and I'm someone who's got the potential to borrow and buy something, but what do you buy? That's the hard part. And even, if I look at myself, real estate agents, I'm sure they knock on most people's doors, but they say, would you like to sell? And I think I'm pretty sure I'd get a nice price for the property. But where do you go? Where do I move to, and what do I buy? So again, the market is pretty warm, pretty hot. What we are seeing in New Zealand, and so I guess we try to look at New Zealand from a regulatory point of view or a prudential management point of view, and what the regulators over in New Zealand are doing to soften house prices over there. And I think they introduced like LVRs around 70%.
Absolutely.
So, is that something that the regulators are going to, enforce over here? We are seeing that they might start to change the way we assess risk around interest-only investment properties versus a P&I investment property. So, the way that the regulators can influence a lender's appetite is getting us to hold more capital to something they might assess as higher risk. So they basically, if they make those decisions, it may mean that there's less people willing to offer loans that are, say, interest-only investor lending, 80% LVR. So that then just constricts the market a little bit more. So we know that some of those regulations are going to come out over the next 12 to 18 months. There's discussion papers coming out from the regulator. A lot of this regulation's coming out of the Basel Accord from Europe. But here in Australia, the current outlook for us is a fairly solid, market from a price perspective. But for us, we're probably expecting to see a slight softening of new fundings on the basis that there's just not as much stock around that we would expect to see at this time of year. any other time of the year.
Yeah, well said. I mean, that's a sentiment that's echoed probably from economists. Banks are saying the same thing, media reporting on it. So low levels of new stock coming on, still a huge amount of pent-up demand. So, you talk about your pre-approval pipeline. I look at ours, I speak to my other broker mates, and pre-approval pipelines are bursting at the seam, which means more people are ready to go. And that's the people that actually organised to get finance, as opposed to the people that are shopping without finance ready to go as well.
Yeah.
And people that can actually just buy properties. And I guess there's more money staying in the economy, not flowing out of the country, for example, or not being spent. Household expenditures probably dropped and peaked back a bit. Discretionary income's gone up. For the people that have what I call COVID clarity, so people that have job security, people that are getting paid their normal wages, or businesses that are ticking along nicely, they're sitting on more cash than ever.
And look, I'm even reading, local papers and local articles, and the sheer amount of money that Australians would be spending overseas on international travel, and all that pent up, well, the fact they're not spending it, they're now reinvesting it in renovations or upgrades or potentially new purchases or investment properties, holiday homes, things like that.
That's right. Yeah, it's when people ask when the market's going to lose steam. I'm like, yeah, as long as people can hold this cash and as long as rates are low, it's a double whammy, isn't it?
And I think that's what realistically the regulators are looking at, and they're trying to make sure that we don't see asset prices get out of hand. But that's where people are just deploying their money at the moment. I guess you've got nothing else to do, and if you've got a job and you're in safe employment and secure employment, and you don't have that concern about your future income stream, then people will look to invest that in a there's no point putting it in the bank and leaving it in a savings account. So people are either looking at equities or houses. So, we've seen a massive increase in equity prices over the last 12, 18 months.
Yeah.
Everyone's benefited from superannuation funds going up and equity prices going up. And, it's just what people are prepared to invest in at the moment.
Yeah, well said. Anthony, thank you so much. It's been wonderful to pick your brain and share your knowledge as well. So really appreciate you taking time out of your busy schedule to impart some wisdom and share that with us as well. And we will drop some links to find out more about Illawarra Credit Union as well in the comments. If you found this episode helpful, please leave us a rating or drop us a line and give us some feedback as well. But to wrap up, Anthony, thank you very much. Really appreciate your time and effort.
Thank you, Aaron. Cheers.
Excellent. That's been another episode of the Australian Property Investment Podcast. We stand for helping investors make better property decisions. So if you are thinking about buying that next investment property, you want a second opinion, or you want something to look under the hood of your portfolio, we'd love to help, and we'll be in touch very soon with our next episode. Thanks very much.